Everyone thought they were finished. A failed product. A collapsing reputation. Investors walking away. And yet just 12 months later, they became the fastest-growing income ETF issuer in Europe. This is the greatest comeback story in income investing. The collapse. In 2024, income shares launched in Europe with a simple promise: high monthly income using covered call strategies on individual stocks. The formula was familiar. Buy the shares. Sell out-of-the-money call options. Collect the premium. On paper, the yields looked incredible. In reality, investors watched their portfolios slowly bleed. The upside was capped. The downside was unlimited. And the net asset value kept falling. It was the textbook definition of a yield trap. High distributions, but shrinking capital. Most fund managers would have blamed the market. Income shares didn't. They listened. The turning point. Not to analysts, not to competitors, not to financial media. They listened to their investors. The message was blunt. We want income, but not at the expense of growth. Stop limiting our upside. We need stability, not just yield. So they did something almost no fund manager ever does. They admitted the strategy was broken and rebuilt everything from scratch. The reinvention. 6 months ago, they scrapped covered calls entirely and replaced them with a structure no ETF provider in the world was using. A hybrid model, 25% direct stock ownership, 75% cash secured put selling. Instead of selling upside, they sold downside insurance to the market. Here's why that changed everything. 1. Unlimited upside. The equity portion now fully participates when the stock rallies. 2. Premium income. Put options still generate consistent cash flow, without capping gains. 3. Interest on cash. The collateral isn't idle. It earns yield on top of option premiums. 4. Reduced drawdowns. Only a fraction of the portfolio is directly exposed to falling prices. Same goal, income. Completely different engine. The results. Look at their Tesla income. ETP, 6-month return, plus 58%, 3-month return, plus 39%, since inception, plus 42%, distribution yield, over 56%, expense ratio, nearly half of major U.S. competitors. But the real headline isn't the yield. It's this: the NAV is growing. The income isn't coming from your own capital being returned to you. It's being generated. That's the difference between a yield trap and a sustainable income machine. The explosion. In 1 year, income shares went from 5 struggling products, damaged credibility, low assets under management, to 19 actively traded ETPs, assets up over 7 quarters. One of the most traded income ETF providers on the London Stock Exchange. They expanded across Tesla, Nvidia, the S&P 500 Gold MicroStrategy, Alibaba US Treasuries, and more launching soon. From near irrelevance to category leader. Why this matters. For European investors, this is a big deal. US markets are flooded with income ETFs. Europe isn't. Income shares change that. No U.S. withholding tax, ISA and pension eligible, listed on major European exchanges, fully regulated. For the first time, European investors have access to sophisticated single-stock income strategies on home turf. The real lesson. This comeback wasn't driven by ego. It wasn't driven by marketing. It was driven by humility. They didn't defend a broken system. They didn't blame investors. They didn't double down. They asked one simple question: what do our clients actually need? Then they built it. The bottom line: they went from failing strategy, eroding NAV, investor distrust near irrelevance, to a unique global strategy, growing capital, industry-leading yields, explosive asset growth, all because they listened. That's not just a turnaround. That's how trust is rebuilt in financial markets. And why this may go down as the greatest comeback story in income investing.